you flipping real estate inside your self-directed IRA, inside your self-directed 401k, or really inside your self-directed retirement plan? If so, I got some bad news for you. Under the tax code, it says that while the purchase and sales of property is tax exempt, you don't have to pay taxes inside your retirement plan. But if the property that you're selling is considered inventory or an asset that is normally sold to customers in the normal course of business, then that will be a taxable event. In translation, flipping is considered inventory and is probably considered an asset that is bought and sold in the normal course of business. So if you flip real estate, if you flip any sort of asset within your self-directed retirement plan, tax code says you have to pay taxes on the profits generated. And even more bad news, the taxes are basically going to start off at 37%, and you're allowed to have the first 12,000 at a relatively lower bracket. But once you exceed 12,000 bucks, you've got to pay taxes at the 37% tax bracket. So if you're going to be flipping, oh, and by the way, a quick little caveat, a little get out of jail free card, if you will. A lot of people say, oh, you have to sell more than 5 properties to be considered flipping. Oh, you have to sell more than 2 properties, whatever. Well, the IRS says you have to be doing the activity continuously throughout the year. So if you're not doing it continuously throughout the year, that might be a little gray wiggle room area for you out there. But there's no set number. The IRS doesn't define how many properties you have to buy or sell to be considered to be in this classification. And I think it really all goes down to what was your intent whenever you bought that property? Was it for a quick resale, or was it for a long-term buy and hold? If it was quick resale, you're flipping, you're busted. Now, how are we going to mitigate those taxes? There's a number of ways to mitigate the taxes. I just want to talk about the most simplistic because the other ones get complicated pretty darn fast. The most simplistic way to keep on flipping inside your 401k or your IRA and lower the taxes is set up a C corporation. Then do the flip activities inside the C corporation. Now the profits are going to go and they're going to stop at the C corporation level. Maximum tax bracket for a C corporation is 21%. So we've gone from 37% taxes on the profits down to 21%. And then if you want to, the C Corp can dividend that down to your self-directed retirement plan. Self-directed retirement plans don't pay taxes on dividends. So we've pretty much cut the taxes in half. Not quite, but pretty darn close to it. Once again, there's some other strategies you can utilize to lower the taxes that much even more. But bottom line, if you're flipping real estate or any other asset, you're going to have to pay taxes on the profits inside the retirement plan. And actually, I said that wrong. Your retirement plan is going to have to pay taxes on the profits generated. And key distinction there, you personally can't pay the taxes. That'd be considered a contribution. It has to be your retirement plan. It's a bit complicated, I know, and I got confused myself there just a little bit. But if you have any questions on this, give us a call, send us an email. We're here to help you out. Thank you so much.